Hi. We've officially made it through the month of June, and Q2 was a real turd. So, July 1st, happy Friday. We're going into a holiday weekend. Let's enjoy it. So, let's get started with a risk disclaimer. We understand there's risk in trading. Please and always use trade capital only. Do not trade with money you cannot afford to lose. Whether trading stocks, options, futures, forex, cryptos, you know the deal. Just getting a couple chart alarms going off here. Let's jump into the charts. Yes, hello. Happy Friday out there. Let me see who's in the house tuning in. Did we cross 5,000 subscribers this week? We did. All right. What's happening, William? How are you? Don, good morning. Chris, good morning. David in the house. Tom, is that you? Strider. Is that Tom? I know we have Thomas. Scott, what's up, man? Nice to see you. Hey, Walt. All right. Morning, Susan. All right, so currency strength chart, take a look. Currencies are ripping for a little Friday. JPY getting very strong, which I'm not complaining about. Dollar is in second, so we're not getting a lot of disconnect there between dollar and yen. However, my Swiss yen position's turning really nicely. Anybody that's been following this week's analysis in the Flex Trading Room, we're looking for a chance to short anything with the Japanese yen, meaning Aussie yen short on a trendline break, CAD yen short on a trendline break, Euro yen, pound yen, New Zealand yen, anything with confirmation looking pretty good. So it comes out swinging. Right now, Aussie yen, New Zealand yen, pound yen, the more promising currency pairs with some decent volatility. Oh, Steve, what's up, man? Yeah, sorry, Steve. I know we have a thumper. That's Daniel. I was like, Tom. There's a Tom Ryder that I talk to quite a bit. So anyway, Steve in the house. Hey Ed, how are you, Ed? Good to see you. Yeah, happy. It's going to be a happy 4th of July. Hopefully, happy 4th of July. So, I think on Stock Twits, I read last night. Let me see if I finished that article. I took a couple screenshots. I know we started off with pretty much one of the worst quarters we've seen in a long time, maybe since like the 1970s. Did I take a picture of that? So, let's see here. Adjusted for inflation, 2022 first half S&P down 25 to 26%, Nasdaq down 34 to 35%, Bitcoin down 64 to 65%. Multiple compression. Next up, earnings compression. So maybe halfway there. That's actually from Michael Burry, Dr. Michael Burry. So I want to take a look at that. So we got a currency strike rock and rolling today. It was a busy week in equities on demand. Here are my notes. What we ended up doing in equities on demand was updating a lot of our covered calls. So if you're not familiar with trading options, typically what we have is we had our 7-1 expirations. Okay, so what we ended up doing is because we're going into a holiday weekend, we had covered calls that expired 7-1. Now, what we did is yesterday we closed, and we could do it today as well. It'd be the same session. We closed for small debits like 0.02, 0.03 debits, and issued new 7-8 expiration covered calls. So what that allowed me to do is collect about 95 to 99% of the covered call profit for the 7-1 expiration, and also add 7-8 expiration with more time and therefore more premium, which was good because we are selling those covered calls against the stocks that we own. So this was a really busy session yesterday, but I'm super happy that we did it. Stocks like Alcoa, Delta Airlines, Alibaba, Pfizer as well. I think we did. Yes, I closed Pfizer and update. Yeah, so a lot of these were updated to a 7-8 expiration. And so what it looks like I have right now is the following. I have 7-8 expirations to repair and get rid of some of these stocks with some profit on Alcoa and Delta Airlines, hopefully. And Alibaba was out to the 15th. Pfizer, PFE, KHC I'm going to lose today most likely. Coinbase, Chewy, and I think that's it. Okay. So 1, 2, 3, 4, 5, 6 stocks And then this week, I'm going to lose KHC for profit, so it's going to get called away with a covered call most likely, and FXI getting called away with a covered call with profit. So these should be profitable, getting called away. Right. So a couple of stocks this week getting called away, which is good. Each one's like $2 to $3 a share for what I own on them. That's fine. I'll take the money. I'll take the margin. And then this 1, 2, 3, 4, 5, 6. Hopefully I can get rid of these stocks as well with some profit on 7, 8. What I've been telling traders this whole week is margin, cash, free capital, ready to deploy. I'm going to go into a little bit of a narrative of stuff we talked about this week in the trading rooms. I think what is super important for the next, let's say July, August, September, let's say the next 3 months, okay, which happens to be Q3. So I guess I can just summarize this and say Q3 things to watch. I mean, it technically has started Q3, so let's talk about it. All right, so Q3. I will take this into a chart. You're good on. I'm good on the notes here. You don't need to see that stuff. But it was busy, and we had a good session yesterday in equities on demand. So let's go into the charts. And pre-market, what are we looking at on the SPY? So we're looking at a slight down day again. It's Friday, probably light volume today. Or maybe we have some surprise little rally. I don't know. Pre-market's 376. In a way, I'd rather see green any day, but 376, I'd rather see the market, start here and end higher and try to fight back. I mean, we have a low, we have a high, and right now we could spend, today and even next week starting out, we could start trading inside of this, and there's really no damage done to the upside or downside, and there's no real control by the bulls or the bears. So we'll be watching price for that. That's the S&P 500. Let me go into some white space here and talk about what to watch for Q3. Okay. So we really have a case. What to watch for Q3? What to watch for Q3? All right, so bulls. Number one, do you think that the bulls are going to be around at all? Right? Everyone seems to think that it's all bears, it's all bear market rally. There's nothing to be excited about. I'm bearish, bearish, bearish. Everyone's bearish. Okay, I get it. Okay. One thing that is, I hate to say this because this is what you shouldn't think as traders and investors. It's different this time. It's really not. Okay. The only real distinctive difference is what we are facing right now is what is this? This is an inflation. So 2022 is an inflation-led recession. Okay. Versus 2008, 2008 was a credit-led recession. So from that standpoint, banks are in much better shape. Companies in much better shape. Valuations are, they've come down a ton. We had like 23, 24 earnings per share and PE ratio or PE ratios on the S&P, which was creeping up to like as high as they've ever been. And so because of the big cleanse in tech and the deleveraging we saw from November of last year and everything dropping this year, heavy in April, heavy again in June, it's mostly, inflation led, right? Inflation led the way, but inflation was lagging, meaning materials did well, commodities did well, energy did well in Q1, and now that's all kind of corrected. So I think this is an inflation-led recession, which means if, this is the big question, if inflation data improves. Inflation data is 2 words. Inflation data improves. I think that's the light at the end of the tunnel. Okay, if inflation data improves, that is at least a glimmer of hope, a shred of optimism to see that this market, think about this. The stock market typically is pricing things in that are happening in the future, right? So if the future is inflation data is better, if there is optimism coming, the market will tend to look past the now and price in what is coming ahead. Okay, so I think right now the big story is obviously inflation. I think that yes, we have an Eastern Europe conflict, and that continues to rage. And European energy is a concern. Eastern or ECB debt and sovereign countries like Italy, having struggles. But I think the big global concern right now is inflation. That's what everyone's talking about. Headline inflation. What's the data? What's the CPI? Look, if that trend starts to go lower, I think every central bank is going to be happy to see that because it means like, oh, look at what we did. We raised rates. We talked about raising rates. We're able to get a combination of jawboning and actually raising rates. Okay. Now I wonder going into July if the ECB, the European Central Bank, will also raise rates and follow suit. So far this year, we've had the U.S. Fed raise rates, the Bank of England, the Reserve Bank of Australia, Reserve Bank of New Zealand, Bank of Canada, and I said Bank of England already. Missing any? The only two banks that haven't done anything, even the Swiss National Bank did something. They went from negative 0.75 to negative 0.25. They're still negative, but they did shift their very deep negative interest rate to a slightly less. Bank of Japan hasn't changed, and ECB haven't changed. Neither one have budged on their rates. In fact, the BOJ still super aggressive. Found an article this week on there are some bond vigilantes that are betting against the BOJ because they don't think they can defend this 0.25 10-year yield. And it is literally like poking at that 0.25%, which does look like a potential. Like if a break happens, we'll see a very massive correction on the Japanese yen, which means in a short amount of time with high volatility, kind of like today, we might have some high volatility days in the Japanese yen to rebalance. Okay, so anyway, back to my point. Inflation data improves, light at the end of the tunnel. I think we go into right now. We have China is now pro-growth, right? Pro-growth. China is reopening. That's a good thing. Okay, so pro-growth, China's reopening. And as long as we stay that way, as long as China stays that way, where they're not locking down the country for COVID again, they keep the reopening, they're pro-growth, pro-real estate, pro-supply chain, pro-food and energy, that's good. I think that also gives a little bit of relief in U.S. equities, and that changes the U.S. Fed tone from hawkish, which right now they have to be hawkish, talking about extinguishing inflation by just continuing to raise rates. But the concern is this soft landing is unreachable, right? So if the Fed has to stay hawkish to extinguish inflation, which they think is their tool by, hey, let's raise rates until nobody wants to buy anything. Want to buy a house? Well, how about 7 to 8% interest rates, right? You want a loan? How about 4, 5, 6, 7, 8, 10% interest rates? No thanks. I mean, that's going to squeeze the consumer. 70% of the GDP in the U.S. is consumerism. So you start suppressing consumerism, we're going to slow. We officially hit a recession with two contracting GDPs. All right, 2 quarters of contracting GDPs means U.S. is in a technical recession. However, of the last 11 recessions, the stock market has rallied 6 times. So this could be one of those times where, okay, we've technically hit a recession. Things are getting priced in. If inflation data improves, I think that the Fed changes from hawkish to neutral or even back to dovish and reverses the path they've been on. So if I'm going to be bullish, all right, this is my whole point this morning on this. Okay, a bullish case right here. This has to happen, in my opinion. And if you have any other input, feel free to chime in. Okay, but a bullish case in this example is inflation data improves, market gets excited, China's pro-growth, focused on the reopening, focused on everything it's been doing, like tech leading the way, real estate, supply chain, food, energy. That would translate into a relief in U.S. equities. China and U.S. both with money supply is over $60 trillion that can still be used in the system, and those two countries can flex their muscles to prop up assets. Now, propping up those assets, does that mean that we have inflation that's going to stay high? Not necessarily, because it may not be all assets, right? It might be stocks. So yes, that's an asset, but we might not see a big run in energy or commodities. It might be just, the stocks that have been beat down 70%, 80%, 60%, 50%, right? Those assets might pop back up and have a little bit of relief. If all of this happens in the US by, I'm saying September, okay? So we have July, inflation data matters. July 27th is a Fed rate decision. August is a summer transition month. The market typically forms highs and lows. September for stocks is usually a very dovish month or a bearish month. It's like one of the worst in history, so it's considered the September effect. If we can survive, if the stock market can stabilize now and get through July, August, September without dropping too much lower, I think October to December, and so even a bullish case is not something I think is happening immediately, right? I think any rally we see now in the short term is exactly that. It's a short-term rally. It's a bear market rally. We're probably going to get faded back down and retest these lows. But I think October to December equals bullish recovery. Now, I will say this. I am willing to wait, and I know that seems like, man, we're waiting until the 11th hour to get this rally. It's true. But it's also, if I have the cash available to do it, I will be more aggressive during this time. So typically the way I trade is buy some stocks, do some credit spreads, lower my cost with options, cover my calls. This might be a situation where I do more long calls. I do more bull call spreads. I try to let my profits run. I get a little bit more aggressive over this quarter and see that if I'm right, I'm going to try to take full advantage of it because there have been some, painful times so far this year. So just watching the overall portfolio value sliding down, even though I'm sitting on positions I like and I'm still losing stocks for profit, making $3-4 a share, sometimes more. If I lose Coinbase, I'm still going to make like $8 or $9 a share. Like I hope I can get rid of these stocks and make some money. But if I'm going to get bullish, I think that we still have a slow drip into getting this kind of light at the end of the tunnel. So question is, does this make sense? A case for the bulls, does this make sense? It's not something immediate. But I think that enough bad stuff has been priced in, and we've had this moving target where it's like, we think it's bad, and then it gets worse. So the market prices that in. We think it's bad, it gets worse. So the market prices that in. And that's what we've been dealing with really since all of 2022. We knew it was bad for Q1 for the most part when the market started to slide and break. But energy and materials kind of led the way, and they were inflation and asset-friendly stuff ended up performing well in Q1 and then just gave it all back in Q2. April was terrible. June was terrible. So here we are kind of neutralizing everything. Everything's red. Everything's ugly. Everyone is feeling pain in their portfolios. There's really nowhere to hide. Unless you are a super bear in the market, you're not really making money right now. You're weathering the storm. You're handling drawdowns. And you're trading. Now, Forex traders, plenty of opportunity with higher volatility, but even still, we've got some great technical levels and positions I'm in that I really like. I like these long-term extremes that we're at, and so I'm buying extremely low, I'm selling extremely high, and again, maybe we have this August top and bottom month, the transition month, maybe I have to wait another month or two. But I do think that, those profits will roll in at some point, and we'll see where we get to. Okay. Yeah, Daniel, show me, man. Let's, you know my email, right? cpulver@markettraders.com. I'm happy to set up a one-on-one. Let's talk about it. Okay, so that's my bullish case. I'll take this over to bearish case, right? Just take everything I just said and make it worse. So inflation data doesn't improve. Pretty simple. Central banks keep hiking rates. Pretty simple. Okay, growth is non-existent, right? We don't have growth. All of a sudden we have stagflation, which means we have persistently high inflation and we have stagnant growth. We'd be in a technical recession, right? With high inflation, that's horrible. And if you have, I know that right now it's like we have a tight job market in the U.S., but if we start to see more unemployment, that's not a good thing. Even though there's like a labor shortage, we could still see higher jobless claims than unemployment. So we could have unemployment, we could have job cutting, we could have corporate earnings. Corporate earnings fall versus buybacks. I mean, if you have a company that's well cash positioned or liquid, more than likely to keep asset prices where they are, you'll see a lot of buybacks coming in the next Q3, Q4. Anything else? So in this case, bearish case is corporate earnings would be terrible, right? Our next round of earnings are going to be pretty bad. The guidance, the outlooks are going to be abysmal. So it doesn't really seem like that's any different than what we have right now. The threat of a recession, we're already in one. Okay, central banks hiking rates, we're already seeing that. Growth is in non-existent. Kind of already see that now. Stagflation, that word's getting tossed around. It has been tossed around since last year. Job cutting, it's already happened in tech. It's happening in crypto, right? Earnings, well, we've had decent earnings, But because the sentiment's been so bad, corporate earnings haven't really helped. We've seen companies beat on the top and bottom lines with revenue, earnings per share, and still watch the stock fall because everything is taking it with it. So like when you have red in the stock market, it is like quicksand just dragging everything down. Okay? So bearish case is pretty much more of the same, and we can't escape it. So the reality is, how do we trade it? Like I said, timing wise, and this is the hard part, if you're going to make a claim to be bullish or bearish, you don't put a timer on it, right? If you're going to put a timer on it, you can't make a case to be bullish or bearish. So what I'm saying is, I think that we are still in a wait and see time right now. We're in the slowest part, typically volume wise, for summer trading. We could have some surprise volatility, of course. I'm not saying that we can't. Like Forex might have some surprise pops here and there. August is always kind of that scary transition month where I've seen flash crashes happen. But in stocks, we might have a very slow July, lower volume. And what I'm saying is, as long as we stabilize at these lows and not push too much lower, okay, we'll see where if this light ever pops up. But for a bearish case, things are already bad enough. Can it get worse? Sure. I just read that tweet from Michael Burry. That was yesterday. And he's talking about we're halfway there. That corporate earnings are the next compression, and it gets worse. So another, what's that mean? The index goes down another 10, 15%? Maybe, right? We've already had 20+% sell-offs. We've already had 30+% sell-offs in, respectively. The S&P was down 20+%. The NASDAQ was down 30+%. The Russell was down 25 to 30%. The Dow was nearly at 20%. And historically speaking, for like 80 years, the market's never finished lower than that 20% level. If we hit 20% the first part of the year in a sell-off, it's never finished below that. So is it different this time? I don't know. I'm going to go with the 80 years of history that shows that it's going to still find a way to bounce back. So all that being said, for this little narrative this morning is this. If we are already down 20%, okay, I think that if this happens on the left-hand side, if this is going to take place where the market is looking for anything optimistic, anything bullish, I think the market at least makes an attempt to fight back at least halfway. So let's say we've had a 20+% drop, even a 30+% drop in the NASDAQ. Now, I'm not saying this happens for every individual stock, right? There are some stocks that are down 60, 70, 80, 90%. Those stocks are going to have a heck of a time coming back. Okay, now, if they do come back, if you're down 90% from the top to bottom, if you get halfway back, you're going to see a 3, 4, 500% rally in some of these stocks that are super, super cheap right now, mainly in tech. I'm a little skeptical of getting into tech unless it's a company that actually has cash, has manageable debt. I'm not going to say no debt, but has manageable debt and offers something that is not just one of many. It's not like a saturated environment. Okay, so there are tech stocks we play in Equities on Demand that I like. I mean, one that I'm a patron of is Chewy, Chewy.com. It's pet food. It's like the Amazon of pet food. I like their stock because it's a company that I can use. It's a brand I've been with for 5 years. I mean, anything you need for your pets, you can get them, and it's at your house within a day. So logistically, seems like everything's working. Is this something that's a company that could be bought out by Amazon? Very much so. But will it? I don't know. We'll find out. But am I interested in like some SPAC plays? Like, oh, look at this, it's only $2. Okay, well, where was it? Earlier this year. Oh, it was at like $100. Yeah, I'm not really interested in those stocks. Those are like that's like the classic Warren Buffett. Early in his career before Charlie Munger came into his life. That was the cigar butt, right? That one last puff, that one last hit. Like, yeah, maybe it pops up and gives you some profit, which again pays pretty well, but it's not a value play. It's not a long-term play. You know, so indices wise, if we at least fight back halfway, we've been down 20%. Do we have a 10, 15% rally to cut some of that deficit down? Sure. If we have an amazing rally, do we end up getting back where we started? I think that's a case as well. It just depends on how bullish are we going to be, right? How bullish are we going to see? How much of a recovery do we have? But I do think at least we don't finish at the lows. I would be, again, probability wise, history says it. If we're at the lows and we finish at the lows, I don't think that's ever happened in the history of the stock market. So maybe that's where it's different this time, but I don't think it is. I think we try to make an attempt to finish off those lows and we get a little rally. So what I'm trying to do is be patient, keep cash at the ready, and get prepared or be prepared for any type of rally that I can be aggressive on. If I can be aggressive on a rally, look, I don't need to hold this to new highs. If I'm aggressive on this rally and this gets faded later, so be it. But if it's short-term profit and the right account, like an IRA, it's growing tax-free. Take that profit. you know? So anyway, that's my stance. That's my thoughts. We've had a lot of discussions about this in the trading rooms, flex trading room, equities on demand, and this is kind of my summary for this week. To me, I mean, this is, portfolio managers, hedge fund managers, people that I follow out there that have made cases that are both good and bad. So this is kind of my conclusion. I think there's a reason to still see a recovery this year, or at least a fight back. I don't think it changes anything. I will say this: one thing that makes me a little concerned is, let's say we have a bullish case and the market rallies like crazy. If we do it because the Fed goes from hawkish to dovish all of a sudden, if the Fed starts, well, we're not going to raise rates, we're actually going to keep rates right now at like 2%, and the market's already priced in 3.5%. I don't know if that gives the market slack or the Fed slack to then keep raising rates in 2023 if needed, or to start staying where they are, or even cutting rates into 2023. Just depends on inflation data. So honestly, like, this is an inflation-led recession. And so if the market believes that inflation is behind us and improving and getting back down to that, manageable 3%, manageable 2%, ideally target rate 2%, then the central banks are going to change their tones a ton. All right. So anyway, that's my PSA for today. Hope it makes sense. Hope it helps. But that's what we'll be looking for. So going into August, September, I think this is really all about, if we're going to see these big changes, it's probably going to be like middle to late September. Just because slow trading, low volume in July and August typically. Historically, September is a really pretty terrible month in stocks. Now, that could change. It could happen earlier, but we still have inflation data coming out in July. We have a Fed rate decision late July on the 27th. We have the ECB, which for the first time in a decade might be raising interest rates in July and September. And if they do, again, that's the Eurozone trying to get out of some of this inflation stuff. Okay. Yep, good point there. Chris says, I believe that inflation is peaking, but corporate earnings are falling. So that's a good point. I think that's why the compression is still there, right? So case in point, we have a ton of earnings coming in July and August, right? We have a lot of earnings. We have another round of earnings July and August. If corporate earnings are falling, that's the extra level of compression that puts more pressure on the downside right now. So I don't think that changes anything that we haven't already seen. In fact, all that does is put more pressure to the downside, and we keep peppering those lows a little bit more. We keep pounding those lows a little bit more. And it really doesn't look any different than what we've seen the last couple of months, which is the bulls are having these very short-lived rallies and the bears are fading. So if corporate earnings are proving to be bad, then yes, you're probably going to see more red, and, long puts, bear call spreads could be your friends. Sitting in cash could be your friend, right? Am I switching portfolios all the way to, like, oh, I'm going to go into a 10-year bond yield? No, I mean, I'm not interested in a fixed 3-4%, 2%, whatever. I'm interested in making money, as much money as I can with the least amount of risk. If right now my best risk profile is, if I have cash, don't use it yet, right? Wait for a little bit more of the coast is clear. Wait for the green light. Wait for the light at the end of the tunnel. And I think that maybe that timing is if we get through the earnings, and then we see that inflation is improved, and we see that the Fed and central banks are changing their tone. One thing that I think has been a clear lesson the last 10 plus years is, don't fight the Fed. Don't fight the central banks. If the Fed is all of a sudden going to start, going dovish again or going neutral, and the market sees that as an optimistic sign, believe me, the market will be desperate to rally. But I don't think you need to be early. If you're early, guess what you're doing? You own stocks and they're dropping, and they keep dropping, they keep dropping, they keep dropping, and that's frustrating. So I think if you have cash, you got to wait. I think if you want to play the game, you got to be bearish right now. And I think that bearishness in that case to keep peppering those lows will continue the next couple of months. So, but yeah, I think earnings is going to be a rough go this next couple of months. But we'll find out. We'll be looking to trade it through the trading room. All right. So I'm going to take a screenshot of this. I can share this with my traders that aren't with me this morning, or they're watching this recording. But I'm going to take a screenshot just because. And that way, if anybody's asking, you can have it. So you want me to post this in the chat? I'll post a screenshot of that if interested. So I'll turn this into a hyperlink, post it in the chat. Let's see if that pops up. There we go. Okay. So a little Q3, Q4 outlook. There you go. That's in the chat. Okay. All right. So it's 9:31. Wall Street is open, and the SPY is right where we thought at yesterday's close, pretty much. And we're going to see what the day is made of. Amateurs open, pros close. Let's see what the market gives us. I know that June is over. Q2 is done. There's a lot of dumping of stocks yesterday to kind of wrap up. I know a lot of portfolio managers and mutual funds get dumped at the end of the quarter. So that's why we saw the last couple of days selling was pretty aggressive. I think we have at least, again, if we're not at this high or not at this low, we at least have a little bit of a rally coming in the short term. Maybe, today into next week. Next week's a short and holiday week. We start on Tuesday again. So we might see a little bit of a rally there. And we'll just be watching. So let me take a quick look at the currency strength chart again. Dollar still strong, yen fading off those strength highs a little bit, and we have CAD, Euro, and Swiss all neutral. Pound and New Zealand, Aussie's the weakest. All right, so that's where we're at right there. I can delete this. Let's go back into the chart. Any charts you'd like me to take a look at? We'll go with some currency pairs. We'll talk oil, gold, silver, dollar index. I saw some chart alarms going off this week. So oil is sitting at 108. There's a lot of volatility on oil. Again, there are production constraints, production limitations, and oil is quite volatile in between this low, this high. We have a potential wedge that's forming as well, where the prices are going to bounce back and forth. There's a lot of jawboning. There's a lot of geopolitics. I don't know where oil wants to go. I've seen the case where oil's going to $200. I've seen the case where it's going to $70. I don't know, right? I'm trying to be price dependent and follow the price and not try to call and have some type of major forecast, because if I'm wrong, and look, oil could go nowhere. Oil could literally stay in this range for the next 6 months. And those that want it to go to 200 are banging on that drum, and those that want to go to 70 are banging on that drum, and oil just does this, right? We've seen long periods of time where oil just ranges. And while we kind of work our way through this high energy inflation environment, we'll figure out what oil wants to do, because ultimately energy prices have led to a lot of the really high headline inflation. Okay, dollar CAD. Yep, take a look at that one, Scott. Sure. All right. Let's see here. It says something when I'm watching Chris rather than live golf. Yeah, hey, well, this is a 30 to 45 minute segment versus watching golf for 3-4 hours. Yeah. Where are they playing at? Is it Pumpkin Ridge this week? Live golf stuff. By the way, did you know that LIV is Roman numerals for 54? And there's a clause in that league that if you shoot 54 during a round of golf, they give you $54 million. That would be bad, right? Have a career day and shoot, that was Annika's Vision 54, right? Fairway green birdie, green birdie. Make 18 birdies, shoot 54. Pretty good stuff. Okay. So let's look at oil. Let's look at gold and silver. I see there for dollar peso. Sure, we'll take a look at that. So gold, interesting. Gold just snapped to these lows. I think gold has a lot to do with the dollar. If the dollar index, which I believe it's still pretty firm. Yep, so dollar index creeping up to highs. I said it this week in the trading rooms. If the dollar is going to creep up to these highs, okay, there is a potential, so let me use a straight line here. There's a potential rising wedge. So we have this low, we have this high, and we're creeping up to a fresh high. I could see this setting up for a rising wedge. If we have some confirmation, and again, that's going to be the key here, I'd like to see this fail, start breaking back down, and this should have room to drop all the way back down to where we started this wedge. So a correction, I think a technical correction is still long overdue and still likely going to happen in the dollar index. And so if the dollar index is going to correct like I have drawn out here, gold will pop back up, silver will pop back up, possibly oil pops back up as well, but we'll have to watch the dollar. Okay, and that also affects our currency pairs. Euro dollar sitting at 104, 103.50, pound dollar at 2100, Aussie dollar, New Zealand dollar, dollar CAD. We'll watch those pairs too. Okay, all right, so that's oil, gold, silver, XAG. This one also tapped some lows. I had a chart alarm go off this morning. Oy, silver drop big time. Interesting. Now, from my technical side, I think that silver is in a really good spot to have this low and have this low actually bounce. And again, maybe it doesn't look like that because, well, why'd you buy it? Well, it came back and filled this inefficiency in pocket, which also was past resistance right around $19.60. So honestly, I don't mind owning silver. I don't mind buying more silver. My break even on silver, I own SLV, and my break even is like $20. So SLV is probably down, right? We're trading at 18.11, but we're coming back into this gap around $18. So you can see that we are filling past resistance plus our gap plus our pockets. And if I have, let me double click on this. So this is what I'm going to look for. Can you see that this is a daily time frame? We have a low in price, but we have disagreement with momentum. We also have slight hidden bullish divergence with the relative strength. To me, I see this as a case as we start to bounce. Now, is it now? Is it the month of July? I don't know. Maybe, but maybe it's that transition month in August, like I've seen for a lot of years. Maybe July is one of the slower months. Maybe the market's ready to take a vacation for the month. And then August we come back in and try to figure out where we're going, find, form some tops and bottoms. All right. What else we have here? Dollar CAD, CrowdStrike, BX, FCX, FCX is copper, Freeport, yeah. So that Head and Shoulders is playing out, and possibly already done, but there's still. I'm a little hesitant. So look, Q1 I was all in on energy, all in on oil, gas, commodities. We took a ton of profit on. We made some good profit on FCX, CLF, X, Halliburton, SLB, CTRA. We made a lot of good profits in Q1. So I think that if I look at this on the higher time frame, we're right in the middle. Now we could have this. We could have a broadening formation, something like this, where this, the broadening formations are tricky because traders are like, oh, support's breaking, sell it, and then the market bounces. So if this is a broadening formation, then we're looking to bounce and pop back up here, and that's a good opportunity to be buying, FCX around current prices and head back up to $40. But my concern is that if we're not hitting resistance, if we didn't peak at resistance, and then we have support levels way back here and way lower, that given the current environment, if inflation data is going to keep improving, copper, aluminum, steel, silver, commodities in general, oil, if they keep dropping, they could be dropping hard. Those are oftentimes seen as value plays. We might not see the value play. If the quicker buck is in technology, that might be the better play for when the bulls are ready to pop back in, versus what has had a pretty good performance this year. This is, energy sector is reverting to the mean right now. It was up 50+%. Now it's up like 20%. So we've seen a big reversion in some of those well-performing stocks and sectors early this year. Alcoa, yep. So I'm in Alcoa trying to repair this one. We're trading at 45. I covered this one going out to next week at 51. This stock's volatile enough. I hope I can get it called away. If I do, I'm going to make, not a ton. It's mostly repair, like 70 cents on it, but it'll be okay. The other ones I'm looking to lose, hopefully $3, $4 a share. I know I got a lot of requests. Dollar CAD. If dollar CAD's back above 1.30, I'm going to stop out of my sell trade. We took a sell trade at 28.50 this week, was a stop sell that got filled, and my chart alarm is set at 1.30. I'm watching this right here. So if we hold, okay, a little head and shoulders pattern at this top. If we hold right here, we sell off, we pull back, we sell off again. We have a new monthly pivot in July. Hopefully that gets tapped. Plus we have a weekly pivot and a couple of daily pivots with some pockets. So as long as we don't break above this high at 1.3020, hopefully the dollar CAD will continue to drop. Again, dollar index could be a factor there. Dollar index makes a high, creates more divergence, and then drops. I'm looking for that timing over the next 2 to 4 weeks. So I'll be watching dollar CAD for that. That's CrowdStrike. So 167. This head and shoulders, like I think you said that earlier, this head and shoulders could certainly be playing out. There's a low. This is more of a crown pattern. Okay, crown pattern right there. So I would look at, that looks to be like fade the rally. Fade the rally, this could be going into like a longer falling wedge and then restructure, reprice. Maybe this thing drops to like $100. I'm just saying, like, I don't have a lot of confidence in these that look like they have these really ominous patterns, and there's lots of room all the way back down. Also, if you see PE ratios, at, 30, 50, 80, I'm really not that interested in jumping into them. So it doesn't even show it here. Let's take a look. CrowdStrike. I'll go to FinViz, CRWD. I want to look at their PE. So we have forward P of 95. It's just way too high. Now again, I know tech typically runs with a higher PE than most, but that's still way too high. They also have cash. They have some debt, not a ton of debt, so I'd say it's manageable. Next year's growth 46%, next 5 years growth 72%. Like that's an incredible forward guidance, but I still think that PE ratio has to come down. So CrowdStrike would be on my radar for if I was looking to buy it, I'd try to buy it, at lows. Like if it comes back to 137, pretty interested. Lower my cost base, use options, and if you could drill this thing down to $100, you could look at credit spreads right now at 170 and take those credit spreads out to like October, November, December. Stagger out some credit spreads for later this year because if we have a recovery, this stock might very well be down to $100. But if you have a credit spread, you have that long put you can cash in. So for stocks you like, I mean, again, I've got to think probably 6 months out. Right now, I feel like there's so much the market has to get through to actually turn bullish that my best trade right now would be a little capital allocation with a credit spread so it doesn't cost me a ton. So I have a sell put, I have a buy put. If the stock price goes down over the next 3 months or more, I could own it cheaper if I wanted to. If I don't want to take any assignment, I can just lose the credit spread, and let's say it's $1 spread, I lose 50 cents. Big deal. Go find another trade. But if you want to own the shares and you have the chance to own it cheaper, it works. Now, in some cases, you can do a credit spread, go way out in the distance, but you can still get assigned. So we have to manage that too. If you did get assigned, then you still end up closing long put, neutralizing the position, and still take the small loss with the credit spread. But at least that's the way I'd like to trade it. If I want to buy stock, I think a credit spread is a great way to start because if the price goes against you, you have that long put working for you. So that way, every tick to the downside, you've got that long put that's gaining value. Okay. BX, Blackstone Housing. This is probably taking a hit. I want to take actually a look at Toll Brothers, who are at 9207. Looks like a nice little channel on this one. So this is BX. Nice to see some stock traders in here. So a little channel to the downside. Again, past resistance over here with pre-COVID highs. This could be dropping again. I mean, I wouldn't mind owning this in the mid, let's say low 70s to mid 60s. If it just keeps getting pressure to the downside. Also, housing is slowing. The 30-year mortgage, I think, has come off the highs at 6+%. Let me check Mortgage News Daily. Yeah, so we were at 6.1 or 6.2% not that long ago. We've come down to 5.7. What would be really interesting in the housing front is if the 30-year fixed rate gets back below 5. If we get back below 5%, I think we're going to see a pretty sustained housing market. Right now, what is in need is supply needs to catch up, right? Inventory is so low from, we traded this in Equities on Demand. We traded Pulte Homes, KB Homes, Toll Brothers. Those are some big housing builders. Also, Lennard Homes, LEN is the ticker, or Lennar, I think, LEN. That was a little bit more expensive, so we only took a couple trades on that one. But this one's also been declining. So we were in Lennar when this was at $90+. We took a few trades and made some nice profit, but I'm glad we didn't stay with it because now it's down, from the highs, probably down 30-40%. Down about 46% from the lowest price, and current price is down about 37%. So yeah, it's expensive. Pulte Homes, PHM, we're trading at 41. We own the shares in the low 40s. So we took ownership of this. I think we own it in the low 40s. I can confirm that here with my spreadsheet. And we're trying to lose it at 50. This is one we can repair. We have a covered call out to July 15th. And PHM is what I'm looking for. PHM. So I own it at 42.69. So even Pulte, even though it took a big dip to the downside towards 35, I'm only upside down about $1, $1.50. So again, does it pop back up here towards 45? Sure. Can I cover this again and repair it? I'll probably push it out towards the end of the month, or I'm sorry, end of the year, and just kind of sit on this one and lower my cost. Or if I can go month to month, I don't know if this was weekly or monthly options, but if I go, kind of month to month with those big options, expirations like August 19th, September 16th, October 21st or 20th, whatever those big monthly expirations are, then collect a little bit more premium on that. Other ones, KBH all the way down towards 25. We said We do have a credit spread here, the 27 by 26. That's in profit. So we've taken a couple trades in this one, and then Toll Brothers TOL is another one. Toll Brothers off the low. We have a 50 by 49 credit spread. That's out to next week. We might end up taking a small loss on that one. Which, again, no big deal, because what we can do is take another credit spread, push it out a couple of months, and sit on this one. Okay. Let's see here. QS. So Susan's asking QS and Matic. QS. So I'll say this. I do own some QuantumScape. We took a trade. We did this. What was it? I can check. I know we did a credit spread. I don't remember what the legs were. I think I own it in the teens. I have it right here. Where's QS? So I own the shares at 19 from the assignment. I did a long put, covered calls, and one's out to July 15th. So I own the shares at 15.03, and right now it's down to 8.77. So what I'm going to have to do on QuantumScape is just wait. At this point, this is one of those candidates where the stock could recover with a tech-led recovery, right? Tech-led recovery means this thing jumps. I'm not looking for like some crazy big rally. I think that if I get back, so I own it at $15. If this came back to $20, I'd be really happy with that, And so from this, I mean, I just think it's unrealistic to expect this, at least for this year. I think it's unrealistic to think that this stock is going to go back up to where we started. I think if this takes out a high, are you in profit? Because if I own it at 15 and it comes back up to this high around $22, I should be happy taking profit there. If we can let it run and somehow get to that yearly pivot at $30 or $40, that's a 5x trade. So I think be realistic with some of these stocks where they might look inexpensive and they might seem like a great bargain, but that's a cigar butt. You toss some money at it, you hope it's a low risk that pays out nicely, but they might not pay out. So, but I have QuantumScape, so I'm in it, but I'm just telling you where I'm looking to protect it. Matic, what is this one? Is this a crypto? Honestly, from the crypto side, I don't care about anything other than Bitcoin and Ethereum. I think everything else is a complete coin flip, whether they survive or not. I mean, seriously, the only one that might have some speculation would be Litecoin, because it's been around a very long time. But I think the crypto front, blockchain, Web 3.0, moving forward, getting rid of all the altcoins and crap coins and yield farming, all the stuff that's literally collapsed this year. When Luna collapsed and Celsius is going bankrupt and crypto's firing everybody, I think Bitcoin, Ethereum are the two steadies to at least be interested in holding. So I don't know. I don't have a lot of optimism moving forward in crypto right now outside of Bitcoin, Ethereum, because of what they mean for market share and market cap, and what they mean to the bigger picture of digital assets and a network and store value. So I mean, you can tell me, look at Shiba Inu, look at Doge. Okay, for what? I mean, if you're holding them, I hope they work out for you and they pay you. But if they never do, I mean, you can't say you haven't thought about it. But Matic is one of those where it's like, I don't know what it's. I mean, if Bitcoin, Ethereum recover and rally, then sure, this is going to be one of those candidates where everything can rally. But I don't know how long term I would be on anything other than Bitcoin, Ethereum. Okay. Excel. Take a look at this one for Susan. So we're trading at 20.09. Now this one has some decent structure. This is good range trading in this one. What is this? So biotech. All right. Susan likes the risky stuff. So we have lows here. We have highs here. It looks like a range trade to me in the low teens, and I would be taking profit pretty regularly. If you can get it, buy it in the teens and take some profit up there. The good thing is, even through the COVID crash in March of last year, the prices remain pretty steady. I'm actually going to put Excel on the list of stocks for next week, because if there's some decent option plays around this, then maybe we can start a credit spread, maybe own this thing cheaper, like 15 or 16 bucks, and try to flip this a few times for $3-4 a share. So I'm going to write this one down for next week's Equities on Demand. EXEL. Okay, put that on the watch list. All right, and then peso, dollar peso. Dollar peso 20.29. I know it's up on the month, but in the bigger picture though, I know the peso has some volatility, but what have we talked about in Flex? And these exotic pairs, I'm not interested in trading every single level. Okay, I mean, if I look at the dollar peso, I don't know where it's trying to go. I'd rather be selling the dollar peso. You have resistance here, resistance here. I'd rather see if this is going to form. I mean, right now it's like we could have a crown, we could have a swing on the peso where this thing wants to go up. I mean, it could go up on risk off trading. That's usually when this thing does the best. It's like risk off trading, right? This was like, what was this? Was that flash crash? Yeah, that was risk off COVID crash in 2020. The last big move we had on that was 2016 when we had like the big the Trump trade in 2016. Right here. This was the 2016 election, and that thing went up 20,000 pips in one day. So it's super volatile. But right now, I mean, the chance would be this: if we have risk-off flows that continue and persist for the next couple of months, dollar peso probably goes higher. Bank of Mexico has been raising rates though, so it's like 7.5% or 7.75% versus the U.S. But I mean, honestly, none of that matters. I mean, Turkey is at 15%, and their currency is still the weakest it's ever been. So the exotic pairs, you still have to take it in stride with risk on versus risk off. Risk off, this peso gets much weaker versus the dollar, but I'm always interested in some structure. If I could sell it high, great. If I could sell it at this high, great. If they're not at those levels, I'm usually not trading exotic pairs. Right? Micro strategy. Yep. Let's take a look at that one. MSTR. I know Michael Saylor's getting a lot of flack right now. So I said I'm willing to buy some more, some fractionals around 150. It's at 170. You know, this is what sucks now. Michael Saylor is a Bitcoin maximalist, and he kind of leveraged MicroStrategy with their balance sheet to own Bitcoin, and Bitcoin is in a bear market. All right, if Bitcoin recovers, I think this stock correlates. Does that mean we're going to all-time highs on MicroStrategy? Possibly not, but I think that we can at least come back in and find support in here, have a recovery. Maybe we get back into the 500 some vicinity. But I think right now it's like if we have a low in crypto, look at how this bottomed out. This looks very, very similar to Bitcoin, does it not? We had that low right around the same time. We're retesting those lows. So camera one on MicroStrategy and then Bitcoin right here. Very similar. So I'd say you got to wait. If we break the trend line on Bitcoin and start to look more bullish, watch MicroStrategy. So I think Bitcoin can lead a recovery for a lot of things. It can lead a recovery for essentially all crypto. It can lead a recovery for a lot of tech, and it can lead a recovery for growth stocks. We also have mining stocks like RIOT and MARA that could benefit from a big push in Bitcoin. But we might be months away from this actually having any type of meaningful move. And if it's going to move, it could be in line with what I said earlier, which is October, November, December, this late Q4 rally, and the market fights back, and Bitcoin and risk assets improve. Okay. All right. So I'm going to do this. I'm going to take a break. I've got about 5 minutes for a class at 10 o'clock. I know we talked about a lot today, and I talk super fast. So I'm going to take a breather. And Equities on Demand students will have a pretty short and sweet session today. We had a really active session yesterday, so all our work is kind of done. We're going to double check our prices, set some chart alarms, and enjoy the weekend, right? If anything, like I need this too. I need to have a little break. It's halfway through. It's been a crazy year. Not in a bad way, just this is what happens. Like you kind of need a little mental break, need to decompress. So holiday weekend, enjoy it. Happy 4th of July. If I do anything on Monday, it's probably going to be a video that I post. I'm not going to be live, so we'll probably be out of town. But anyway, have a great Friday, have a great weekend, and we'll be back for the trading rooms next week, Tuesday, Wednesday, Thursday, Friday, Flex Room and Equities on Demand. And if I don't do anything live, like I said, look for a video on the YouTube channel. But I will say this, we're over 5,000 subscribers from zero from last year, so that's a big thumbs up. Thanks to every one of you. Thanks for the support. Appreciate the thumbs up out there. And keep supporting the channel. Keep passing on the word. I hope this education helps. It's free. I'm not asking for anything. I just like to do it. Okay. All right. Sounds good. Thanks, everybody. Have a great weekend. Happy 4th. And see you next week. Bye.